Okay, we are going to take a look at dividends here and really answer the question, if I am receiving a dividend rate of say 6% or 5% or whatever the company is paying that year, is that what I am actually earning on my cash value? Well, the short answer is no. The dividend, just like the guaranteed rate, is a gross rate that is credited after the insurance company's mortality charges and insurance expenses. Let's get into a little bit more detail here. We're going to look at some numbers as well, like we usually do. But how dividends work first and foremost is if I have an insurance company that has a guaranteed rate of 4% and declares a 6% dividend interest rate for the year, here's how it works is I have my minimum floor of 4%. That's the guarantee they have on your contract. It cannot go any lower than that. And they declared a surplus in earnings that year, a surplus rate, call it, of 2%. The guaranteed rate of 4% plus the surplus declared at 2% for that particular year equates to a total dividend rate of 6%. So that's where the dividend comes from. Now, what's important to be aware of is all of this is a gross rate. So we mentioned that the guaranteed rate of 4% or the total dividend rate of 6% is a gross rate credited again after the company's mortality charges and insurance expenses. And the item to look at here is the net IRR. That stands for internal rate of return, meaning I pay money into a policy. I've got a life insurance benefit. I've got the death benefit here that is always paid out income tax free to my beneficiaries. But the actual cash value growth, what am I actually earning? That's the question. Okay, year over year, they declared a 6% dividend rate, but if I'm not earning that, after all the expenses, what's it come out to? That's the question. And typically you'll find, if things are set up properly, that the net internal rate of return, if I have a 6% dividend, is likely going to fall somewhere between 4 and 5%. Depending on age, health, how the policy is designed, there's several items to consider, but if I do everything right, typically I'll see that dividend, that net internal rate of return over the life of the policy fall somewhere between 1 and 2% below the dividend rate. If you want to shoot it more conservative, say between 1.5 to 2.25%. But we're going to take a look at some numbers here shortly. Let's look at one other thing first though, because when it comes to maximizing cash value, right? How to maximize cash value. We talk about this frequently because in my opinion, it's one of the most important things. Policy design, right? When I actually design a policy, my money can go where? Two primary areas, the premium, or I can direct it toward the paid up additions rider. Premium dollars, first and foremost, buy me a death benefit. The life insurance company with most traditional life insurance policies is going to overcharge me for the cost of insurance or the death benefit up front. That's why with a premium piece, right, if I had a $100 premium in the first year, and typically first and second year, I would see zero of that show up in cash value. As the years pass, I will see more and more of my premium payment show up in cash value. I'll begin to build equity. It will capitalize. Whereas money that is directed towards the paid up additions rider, say it's the same $100, I'll see show up in cash value. Just about all of it. Why I say just about, I hate to throw those terms out there when people sneak things in. The reason why is there are fees associated with most insurance companies when I add funds into PUAs. To give it a quick estimate, if I pay in $100, I might see between $95 and $98 in cash value immediately, and then it'll begin to compound over time via the guaranteed rate and dividends as well. Another important piece is the insurance company selection. That is critical as well. More so with the guarantees. If you haven't watched that video, I would encourage you to do so, where we went into that a little bit more in detail. It's interesting because you'll see the same guaranteed rate of 4% with several insurance companies, yet the net guaranteed values will be much different when we actually start to break it down and see, okay, I'm paying the same dollar in, yet my cash values are different. And it does apply to the dividends as well when we look at the actual performance. And this applies to the individual market and the corporate market. Corporate market puts a lot of emphasis on guarantees, which again, we touched on that. But they will look at the non-guaranteed rate. What I like to do often when we're narrowing things down, typically when we work with someone, we'll show a wide variety of options to start. Different companies, different products, different designs. And as we start to narrow things down, what is always beneficial to see is, hey, what is this product with this particular company and how much I'm paying in? What does it look like based off of the guaranteed rate, the present dividend rate, and a middle of the road projection? Or we can adjust the dividend year over year. We can kick it down, kick it up. And then of course, as the years pass, keeping in touch and running review meetings, in-force illustrations is important. So let's take a look at some figures here. First things first, we've got the guaranteed rate, which this is the policy with the minimum premium policy we looked at. So the approximate 10/90 split, which is about as low as this company goes. It's a little bit lower. Base premium's just over 9, it's about 9.1%, but we drove it as low as we could for this 7-year funding scenario. 50K for 7 years, breaking even between 4 and 5. If you look at the pure guaranteed values on the illustration, it's between 5 and 6. And why I add that is here in this example, we've got a term rider here. We charge the insurance company's current term rider expense. We usually display the maximum term charge whenever we look at the guaranteed values. But here, I wanted to keep it consistent as far as the term expense and then just adjust the rates for a little bit more consistency there. But it doesn't really make much of a difference. Main point, breaking even between 4 and 5, annual internal rate of return and average internal rate of return. Annual displays what I am earning year over year. A great illustration or something to relate it to. What did the S&P 500 produce in 2019? Just about 30%. What did the S&P 500 average over the past 30 years? Maybe it's between 7 and 9%, whatever span I'm looking at, that is. But annual just displays the year over year cash value growth, the internal rate of return. We can do the exact same thing with a death benefit, by the way. And then average factors in all the years. Why it's always going to be lower is it's really factoring in for the early years where I've got that negative hit, that drag. And you'll find in all of the average IRR formulas, or the runs I should say, when it is no longer in the red is when I break even on a cash value life insurance policy. Which, by the way, these reports can be generated with just about any insurance company, any design. It is fairly easy to do. Not all companies offer both annual and average. Most do now, though, when you look at it. So something we can look at based off guarantees, non-guarantees, all that good stuff. So if you are purchasing a policy, perhaps your intention is to obtain life insurance protection via the death benefit, but then you also want the cash value growth and you want to make sure that it's maximized, right? Corporations do this all the time. Requesting the internal rate of return reports. I like to look at the average and annual personally. Some people put more value on the average, depends what your flavor is, call it. You can always request those. And if those are truly maximized, then you're in a position where the policy was set up for optimum cash value. If they are dragging, we want to know the reason why, and can we make an adjustment to improve them. But point here, guaranteed rate of 4%, what did my annual IRR top out at? About 3.35%. Average was about 2.85%. No 4%. So after the insurance company's expenses and mortality charges, there is my net IRR based off the guarantees. Then I've got a present dividend rate, 5.65%. Break even, bit earlier, between years 3 and 4. Same thing. Annual internal rate of return. So tops out about 4.14%. Dividend, 5.65%. What's the difference there? Just about 1.5%. Remember where we've got a gross rate of 5.65 and the net internal rate of return might fall somewhere between 1 and 2% below that actual dividend rate? There we go. As far as what it's topping out at the 1.5. Average over time, see exactly what it hits. Just about 3.75, assuming this dividend rate holds forever, which by the way, doesn't really happen with insurance companies and products. They are going to adjust over time. We are at the end of 2020 right now, just in discussing dividends and insurance with companies. Companies are expecting dividends not to come up over the next 10 years. In the low interest rate environment and what's going on, likely going to come down a bit or stay low. After that, who knows? But that's why it's good to look at different assumptions. Here's a whole life product with an indexed rider assumption that comes out to about a 6.25% dividend equivalent. So meaning if we ran an illustration with a dividend rate of about 6.25, this is what it would net out to. The indexed assumption, we've got more information on that. You can flip back and forth between that and the dividend. Good rider, because if we don't use it, it doesn't cost anything. But if we do exercise it, there's a fee there. So it's always good to be aware of that. But does grant stronger earning potential, and that's why you see stronger internal rates of return. A lot of consistencies here though. Annual IRR tops out about 5.1%. Look at the average as time passes. Fun stuff, right? Point to all of this is dividend rates, guaranteed rates, all that good stuff. Am I earning 6% on my policy? The answer is no. What's the net internal rate of return? If that is a point of interest, if I want to know what is the cash value growing by, because that's of interest to me, well, remember, gross rate credited after the mortality charges and insurance expenses. Hope this helps. As always, if you have questions, feel free to reach out anytime, and we'll talk to you soon. Thanks again. Hey guys, Steve Parisi here. If you enjoyed the content you just saw, please subscribe, like, and hit the notification bell for future videos. If you'd like more information or to see some custom policies for yourself, feel free to call or email our offices at the contact information below.